Mark there. Why such a strong reaction when, the second half isn't going to look that bad?
Yeah, well, that's what the company's said so far, that the second half is not going to look too bad. But, I mean, the shares are down 9%, a big fall for a consumer staple company within the ASX 200. And it looks like earnings for the first half are going to fall somewhere between 8 and 9%, which is the company has said. And this is due to some price deflation as well as soft consumer demand here in Australia. And if we look at Coca-Cola's market, really Australia does dominate its core market. Around 60% of its sales and 70% of its revenues come from Australia, even though it does also operate in New Zealand, Fiji, Indonesia, etc. And I think the market reaction today, really 9% fall due to the lofty valuations that some of these consumer staples have been trading on recently. If we look previous to the 10% fall today, Coca-Cola was trading on around 18.5 times forward-looking earnings for 2013. Now, the broader ASX 200 at the market at the moment is trading around 15 or 14.9 times earnings. So that places Coca-Cola, did place it around 25% premium to the market. Though this was in line with other consumer staple companies. If you look at Wesfarmers and Woolworths, they're both also trading on 18 and 19 times forward earnings at the moment. And it comes down to what investors have been looking for in the market, really. If you look at the growth profile of Coca-Cola, it's quite a mature business here in Australia, but they are looking to grow the business throughout the region. They're looking to Indonesia in particular to grow their business there. It makes up the vast majority of its new group business growth. But I think there's a little bit of cause for concern there. Certainly difficult in terms of competition over in Indonesia at the moment. Here in Australia, really investors have been looking at the likes of Coca-Cola, Wesfarmers, Woolworths for the yield, for the defensive earnings, and because those share prices have run quite hard, you now have to pay a fair bit of money for these kinds of defensive earnings. So with a 10% fall today, maybe some investors will start looking at this as a buying opportunity, though over the next few days we'll probably see some of the brokers start moving their calls on Coca-Cola as they update earnings. But I think a few will be looking at Coca-Cola as a buy now, after now its valuation has come back from those higher levels.
Just want to ask you about Perpetual as well, and this $200 million deal to buy the trust company. How does this fit into Perpetual's strategy?
Look, it does fit into the strategy for Perpetual. They've announced to buy the trust company for around $214 million for $6.39 a share, which includes a 22-cent dividend. Now, TRU already has rejected an offer from equity trustees that was launched back in February, and Perpetual's offer is around 35% premium to the share price prior to that initial offer. And given that the board has recommended that shareholders will accept this offer, given there's no better offers in the meantime. TRU's share price trading around $6.30 today, very close to where that offer price is. So the market not really looking at the moment for any further bids to come through. There could be, but not looking all that likely at the moment. And in terms of Perpetual's strategy, it does fit into Perpetual's strategy to become Australia's largest independent wealth manager. If we look at what this business is going to mean for Perpetual, it's going to increase their private wealth management business funds under management by over 50% to over $13 billion. And they're also expecting around $15 million in synergies annually from 2014, and also a boost to earnings there. Now, Perpetual, if you look at the share price, it's had a super run over the past year. It's up around 90%. Funds managers in general have been quite popular over the past year. Investors looking to buy into these stocks ahead of possible turnaround in market conditions, which will benefit these companies. But I think the market is also particularly liking Perpetual's strategy at the moment. The new CEO really looking to cut costs. He's reduced headcounts significantly, also divesting some of the non-core assets there as well. So I think this is going to boost Perpetual's private wealth division. This is the least volatile in terms of earnings for Perpetual, so that's a bonus there as well. And wealth managers in general still looking pretty good, but they have had a very good run in the market recently.